An individual has a free will, and his behavior is hard to predict. Group behavior is more primitive and easier to follow. When you analyze markets, you analyze group behavior. You need to identify the direction in which groups run and their changes. Groups suck us in and cloud our judgment. The problem for most analysts is that they get caught in the mentality of the groups they analyze. The longer a rally continues, the more technicians get caught up in bullish sentiment, ignore the danger signs, and miss the reversal. The longer a decline goes on, the more technicians get caught up in bearish gloom and ignore bullish signs. This is why it helps to have a written plan for analyzing the markets. We have to decide in advance what indicators we will watch and how we will interpret them. Floor traders use several tools for tracking the quality and intensity of a crowd's feelings. They watch the crowd's ability to break through recent support and resistance levels. They keep an eye on the flow of paper, customer orders that come to the floor in response to price changes. Floor traders listen to the changes in pitch and volume of the roar on the exchange floor. If you trade away from the floor, you need other tools for analyzing crowd behavior. Your charts and indicators reflect mass psychology in action. A technical analyst is an applied social psychologist, often armed with a computer. Technical analysts believe that prices reflect everything known about the market, including all fundamental factors. Each price represents the consensus of value of all market participants. Large commercial interests and small speculators, fundamental researchers, technicians, and gamblers. Technical analysis is a study of mass psychology. It is partly a science and partly an art. Technicians use many scientific methods, including mathematical concepts of game theory, probabilities, and so on. Many technicians use computers to track sophisticated indicators. Technical analysis is also an art. The bars on a chart coalesce into patterns and formations. When prices and indicators move, they produce a sense of flow and rhythm, a feeling of tension and beauty that helps you sense what is happening and how to trade. Individual behavior is complex, diverse, and difficult to predict. Group behavior is primitive. Technicians study the behavior patterns of market crowds. They trade when they recognize a pattern that preceded past market moves. A tremendous volume of information pours out of the markets during trading hours. Changes in prices tell us about the battles of bulls and bears. Your job is to analyze this information and bet on the dominant market group. Dramatic forecasts are a marketing gimmick. People who sell advisory services or raise money know that good calls attract paying customers, while bad calls are quickly forgotten. My phone rang while I was writing this chapter. One of the famous gurus, currently down on his luck, told me that he identified a once-in-a-lifetime buying opportunity in a certain agricultural market. He asked me to raise money for him and promised to multiply it 100-fold in 6 months. I do not know how many fools he hooked, but dramatic forecasts have always been good for fleecing the public. Use your common sense when you analyze markets. When some new development puzzles you, compare it to life outside the markets. For example, indicators may give you buy signals in 2 markets. Should you buy the market that declined a lot before the buy signal, or the one that declined a little? Compare this to what happens to a man after a fall. If he falls down a flight of stairs, he may dust himself off and run up again. But if he falls out of a 3rd-story window, he's not going to run any time soon. He needs time to recover. Prices seldom rally very hard immediately after a bad decline. Successful trading stands on 3 pillars. You need to analyze the balance of power between bulls and bears. You need to practice good money management. You need personal discipline to follow your trading plan and avoid getting high in the markets.